Hello everyone, my name is Cameron Stevens and I'm a local real estate agent here in Los Angeles. Today I want to talk about the real estate market and specifically what in the world is happening to it right now in the middle of COVID-19, focusing specifically on residential real estate. First, let's get a few things out of the way before we dive into explaining the situation. Our Governor Newsom has declared real estate an essential service, and thus real estate has continued uninterrupted during this entire time. Now, yes, there are additional rules such as additional disclosures, as well as obviously following safe health practices like wearing masks and staying socially distanced and sanitizing your hands and wearing disposable gloves. But we are also seeing the proliferation of virtual open houses and digital walkthroughs. You know, there aren't any open houses at the moment, but people are still seeing properties in person by appointment only and completing all other aspects of the process in person as well, like different types of inspections. And many steps of the process have gone digital, like signing loan documents or recording deeds or pulling permits and even ultimately closing escrow. So with that out of the way, let's talk about what I'm seeing in the market and really what my current outlook is for the remainder of the year. The first question I get often is, are prices dropping or will they drop? The answer to that is very unlikely, at least in any kind of significant way. Most entry-level price points in Los Angeles, and that's likely anything from, say, $500,000 to maybe $800,000, are not seeing price drops. Instead, they're seeing multiple offers within days and prices that are over the asking prices. And I'll get to why that is in a second, but let's just run the numbers. So, I haven't seen any predictions of prices dropping than, say, more than 2 to 3%. So let's take the worst case scenario of a 3% price drop. Keeping round numbers, let's use $1 million purchase price, so 3% would be a drop of $30,000. If you factor that into your mortgage, that's about $117 less a month at current interest rates. However, with how low interest rates are at the moment, consider this. That house that now costs $970,000, if purchased at interest rates a year ago, would actually be $313 more per month than prices were at $1 million. That's almost 3 times as much the drop in price at current interest rates. Furthermore, this is a scenario for 3% drop. For comparison, Zillow predicts a 0.5% price overall in Los Angeles dropping in 2021. And regarding interest rates, look, the Fed has already stated that it intends to keep interest rates low and unchanging well into 2021. So that means the above scenario really isn't changing soon. The second question I get is that people have heard home sales have been down during coronavirus. Why isn't that leading to a drop in prices? Well, that's a great question, but we need to look at the basics of supply and demand as well as what's actually happening in the market. Remember Econ 101? Price is a direct factor of the intersection between the supply curve and the demand curve. If supply rises and demand stays the same, prices drop. But instead, what we're seeing is home sales dropping instead due to the opposite, supply dropping. So if supply drops and demand stays the same, prices actually rise. And of course, if supply drops but demand drops equally, prices stay the same. So here's what's happening. Supply is dropping because of 2 main reasons. 1, people are not putting their house on the market if they don't need to sell. Either that's because they don't want people coming through during a pandemic, or people that might have been just testing the market, they're pulling back and not selling. Now is definitely not the time to list that house you bought 2 years ago and you put absolutely no work into, and you want to list it for $100,000 more than you bought it for just for funsies. Absolutely not. But third and most important of all, interest rates are super low. And that means many people that have considered selling are actually just instead staying put and refinancing, staying in their home at that lower rate. Okay, so we discussed why supply is low, which is the direct cause of why the total home sales have dropped in the past couple of months. What about demand? Well, I think there's a very strong case to be made for demand overall increasing, but at the very least, we haven't seen a drop in demand. Let's go over the reasons for this because I think they're more complicated and wide-reaching than what we discussed in regards to supply. So let's actually start by making the case for demand dropping. Coronavirus has put many people out of work or on unemployment. Now, I want to keep this video very analytical and stay away, too far from social commentary, but I will say this. That's a huge bummer, and it's affecting a significant portion of people, my fiance included. However, we do need to keep in mind that Los Angeles is a global city with high-paying jobs from all over the world operating here. I mean, there's many industries like tech that are still going strong and are instead really shifting to something remote. And the sad reality is that most industries and people that were hit hardest from coronavirus are not as likely to be the people that have the income and stability to be affording homes in one of the most expensive real estate markets in the world. The people that have cash still have the cash, and the people with six-figure incomes are very likely to continue to have those jobs. Thus, they're still buying and selling houses. So how about a case for supply rising due to foreclosures from people not being able to pay their mortgage? Well, that's a little bit more of a complicated process. I do think that we will see some foreclosures, but current data doesn't really show any significant increase in foreclosures in Los Angeles County. I mean, much of this is actually due to the fact that banks don't want to foreclose on a house. Banks are not in the business of selling homes. They're in the business of managing money and, in most cases, lending money. And they would much rather prefer to go into mortgage forbearance rather than foreclosure, because that means that at some point they can continue to receive regular payments and then add any missed payments to a later date. That could be actually as far as the end of the loan term. Again, mortgage lending standards have increased significantly since the 2008 crash, and homeowners that purchased in the last 10 years or so have far more equity invested, which means they're far more likely to keep paying their mortgage or renegotiate that forbearance. Finally, let's talk about some reasons why demand might actually increase. Well, we've already talked about interest rates being at historic lows, so purchasing power for individuals is therefore at historic highs. So how about things like general cultural trends that have started to accelerate during these unprecedented times? I mean, one of the major ones is telecommuting and work from home scenarios. The world's been shifting towards forms of digital working situation for years now, and work from home is not new. A global pandemic simply caused that trend to rapidly accelerate to the point that businesses needed to pivot and do so immediately. Though I personally can't see a situation where, working at an office is just gone forever. I know we will see an increase in jobs that are dedicated work from home. We're going to see an increase in jobs with flexible work from home situations. We're going to see an increase in jobs that are a hybrid situation, say, working from home 3 or 4 days a week, and dedicated office space shifting to smaller, nimble, more hybrid situations to accommodate. So what word did I say over and over again? Home, work from home. That means people are rapidly evaluating and reevaluating what home means to them. And they're facing the idea that homes will likely need to have some kind of workspace included from now on. Now, that might be as simple as a den converted to an office, or it might be as drastic as needing to sell that 2-bedroom and actually buy a 4-bedroom house. Now, a little bonus prediction from me here in the city of Los Angeles is this. If people are going to demand more space, but have to stay at the same price point, they have no choice but to look further outside the city to the suburbs. Now, what used to be an option that wasn't even considered during crazy commute times suddenly seems far more reasonable with work from home. I mean, I'm predicting an increase in value of homes in suburban areas of this city, which I think will actually only be accelerated by the increase of self-driving technology that's pretty rapidly advancing for use in major metropolitan areas. Now, that's just a prediction, but to me it all seems very logical, although all in all, I do believe this is going to be a major driver of an increase in demand for housing. Finally, I want to leave with a parting observation that I think many people forget about, but I do believe, at least my research leads me to believe, is a demand driver for more than people realize. I took a look at the moving data since March in the United States. The usual suspects, of course, are popping up on the list for their lower cost of living, like Austin and Portland and Denver and Charlotte, etc. But what are the 3 cities people are leaving the most? New York, Chicago, and San Francisco. And where are they moving to? Well, what could be the opposite of cold, highly condensed city centers that have major global job markets? How about the sunny, sprawling oasis of single-family homes that is Los Angeles? That's right, and this isn't a guess either. The data that at least my research has indicated is backing that up. These cities have real estate values and salary positions that are equal to, if not greater than, Los Angeles. So people are moving from these cities, assuming that, of course, they're keeping their jobs or able to move to something comparable. They're having no problem paying our Los Angeles prices. To wrap up here, there is a huge amount of uncertainty lingering over all of us right now. We all have questions about where many aspects of our lives are headed and what we should do about it. That being said, if we focus specifically on the residential real estate market, for the reasons that we just talked about, I don't see any kind of major crash in the future. Instead, the age-old advice remains as sound as always. Never try to time the market. The right time to buy a house is the right time for you, personally. So thanks for watching. I hope you got some helpful information from this video. If you are interested in purchasing your first home, my contact information is below. I love working with first-time home buyers. And if you're thinking about selling and making a move, don't hesitate to reach out. I offer all of the digital tools that are required for selling your house in this day and age. So there you have it. Thanks again.